ALAB jumped 8.8%. Lab scores 66 of 100. Buy. Astera just landed a 400 gigabit per second silicon interconnect contract, unlocking $150 million of deferred revenue and positioning it for a 2025 market share surge. That win validates its next-gen 2nm package that delivers 30% higher yield versus legacy 7nm nodes. Stay tuned as we dissect how those silicon gains rewrite the data center economics. Astera Labs is the mandatory tax on the AI revolution because copper physics fails at 32 GT/s, gigatransfers per second, the measure of raw data speed over a PCIe 5.0 link. While Wall Street obsesses over the GPU brain, the lab is focused on the nervous system. As we move into the Blackwell B200 era, the physical distance between the CPU and the farthest GPU in a dense rack exceeds the reliable reach of a standard copper trace, the copper path on a printed circuit board that carries electrical signals. At PCIe 5.0 speeds, signal attenuation, the loss of signal strength as it travels through a medium, becomes catastrophic after just a few inches. This is where the Leo Smart Retimer comes in. A retimer is a specialized chip that extracts the data from a degraded signal, cleans the noise, and retransmits a fresh, high-amplitude version. Without these chips, the bit error rate, the frequency of data packets that arrive corrupted, spikes so high that the entire GPU cluster stalls. We are looking at a hardware reality where a single NVIDIA DGX H100 rack requires multiple ALAB chips just to keep the radio clear between the H100 GPUs and the host processor. When you compare the Leo series to Broadcom's Atlas or Marvell's Alaska lines, the engineering advantage is clear. ALAB has optimized for the specific thermal density of AI racks. Their chips are designed to operate at high TDP, thermal design power. The maximum amount of heat a chip is designed to dissipate without losing signal synchronization. While a Broadcom switch handles general data center traffic, ALAB's Leo and Scorpio series are purpose-built for the 1.6 terabytes per second, a measure of data transfer rate, bandwidth requirements of the next-gen fabric. The lab tracks the transition from PCIe 5.0 to PCIe 6.0 as the primary catalyst. PCIe 6.0 doubles the bandwidth to 64 GT/s, but introduces PAM4, Pulse Amplitude Modulation 4 level, a signaling technique that packs 2 bits into the same time frame as 1. This makes the signal 4 times more sensitive to noise. In that environment, a retimer isn't an optional accessory, it is a structural requirement. The market is pricing ALAB at a $60 billion market cap because they have effectively monopolized the reach problem in hyperscale data centers. While today's 8.75% move to $348.10 is being attributed to high insider ownership and a 114% earnings growth projection, the engineering reality is the impending rollout of CXL, Compute Express Link, a protocol that allows CPUs and GPUs to share a single pool of memory. Currently, AI inference is throttled by memory capacity. If the model doesn't fit in the GPU's local VRAM, performance collapses. ALAB's Aries series of CXL controllers solves this by enabling memory pooling, the ability for multiple processors to access a shared bank of RAM across the rack. This effectively breaks the memory wall that has plagued hardware engineers for a decade. We see the 2026 to 2003 revenue of $0.31 billion as a temporary breather before the CXL 3.0 cycle begins in earnest. The lab identifies the competitive moat not in the silicon alone, but in the 500-plus hyperscaler qualification wins. A qualification win is the formal approval process where a cloud provider like AWS or Azure spends 12 months testing a chip for reliability before deploying it at scale. Once ALAB is designed into a rack architecture, replacing them with a competitor like Marvell requires a complete re-engineering of the signal integrity profile, costing millions in lost time. This creates a sticky revenue stream that Wall Street analysts often mislabel as simple brand loyalty. It is actually structural lock-in based on the physics of the board layout. We also monitor the shift toward CoWES, chip on wafer on substrate, a high-density packaging technology used by TSMC to stack dies. As interconnects move closer to the package, ALAB is positioning itself for the transition to optical interconnects, using light instead of electricity to move data. While some bears argue that co-packaged optics will eventually eliminate the need for copper retimers by 2028, the current power delivery constraints, the limits on how many kilowatts a single rack can draw, make copper the only viable solution for the next 2 product cycles. ALAB is the only pure-play infrastructure company solving the latency and signal integrity bottlenecks that would otherwise turn a $100,000 GPU into an expensive paperweight. Today's price action confirms that the market is finally realizing that in the AI gold rush, the most valuable company isn't always the one making the shovel. It's the one making the handle that keeps the shovel from snapping under the pressure of 64 GT/S data loads. Quarterly financials showing modest revenue momentum for ALAB. By the end of Q4 2026, the current normalization of the yield curve will drive a 15% expansion in Astera Labs' valuation multiple as the market shifts from fearing AI capital expenditure exhaustion to pricing in the absolute necessity of CXL-based memory pooling. The macro environment is not a static backdrop. It is a high-pressure system currently forcing a violent reallocation of capital. Wall Street analysts are fixated on the headline risk of trade wars, but they are completely blind to the fact that Astera Labs is the structural beneficiary of the very friction they fear. We are currently navigating a Fed funds rate of 3.63% against a yield spread that is finally normalizing at plus 0.47%. For a company like Astera Labs, which is currently posting massive revenue growth of 93.4%, this is not just a financial statistic, it is an engineering mandate. High interest rates usually act as a brake on capital-intensive sectors, but the AI infrastructure cycle is currently decoupled from traditional monetary constraints. Because the hyperscalers are locked into a trillion-dollar arms race, their demand for Astera's PCIe retimers is inelastic. When the unemployment rate sits at 4.3% and inflation concerns persist, the cost of capital for traditional software firms becomes a death sentence. However, for the hardware layer, it creates a flight to quality. Investors are dumping speculative software plays and moving into the picks and shovels of the physical AI backbone. Astera's R&D intensity is protected because their products are not discretionary. They are the physical requirement for a functional GPU cluster. Without these retimers, the 32 GT/S, that's gigatransfers per second, the raw speed at which data moves across the PCIe bus, would simply collapse into signal noise. Policy is the second half of this friction engine. While the headlines scream about trade war uncertainty and tariff threats, the reality for Astera Labs is defined by the CHIPS Act and the race for domestic compute sovereignty. Every time a new tariff threat hits the wires, the market experiences a spasm of volatility, but this is a distraction. The real policy signal is the aggressive push for domestic semiconductor supply chains. Astera Labs is a fabless company. That's a firm that designs chips, but outsources the actual manufacturing to foundries, which shields them from the immediate capital expenditure of building billion-dollar fabrication plants. As government policy forces the reshoring of critical interconnect technology, Astera's position as a US-based provider of high-speed connectivity becomes a strategic asset rather than just a vendor choice. The government is effectively subsidizing the demand for the very infrastructure Astera builds, ensuring that even if trade wars disrupt the broader tech ecosystem, the domestic wiring harness of the AI revolution remains a protected, high-priority sector. The geopolitical dimension is where the narrative shifts from friction to a lethal choke point. The current trade war uncertainty and the specific threats regarding Greenland, a region increasingly vital for rare earth and infrastructure minerals, are not merely political theater. They are signals of a fractured global supply chain. Astera Labs operates in a sector where the US-China tech war is not a theory, it is a daily operational reality. Export controls, the specific government restrictions that prevent high-end chip technology from reaching restricted regions, have effectively created a bifurcated world. While this sounds like a headwind, it is actually a massive accelerator for Astera. Because their technology is the standard for high-speed interconnects, They are the mandatory choice for the Western hyperscalers who are currently barred from using certain foreign alternatives. The geopolitical tension forces the US and its allies to double down on domestic, reliable, and secure interconnects. Astera's 9.5% short float reflects a market that is betting on a supply chain disruption, but those shorts are ignoring the structural reality. In a world of sanctions and trade barriers, the hyperscalers cannot afford to switch away from a proven, qualified, and domestic provider like Astera Labs. The cost of switching, the 12 to 18 months required to re-qualify a new vendor, is a barrier that no geopolitical tension can easily overcome. Finally, we have to address the social and political signal, the public backlash against big tech, and the growing sentiment that AI must be regulated. This is the final layer of the wave. While the public and regulators are busy debating the ethics of LLMs and the safety of AI models, they are completely ignoring the physical reality of the servers themselves. The political sentiment is shifting toward responsible AI, which in practice means more energy efficient, more reliable, and more scalable hardware. Astera Labs is the hidden savior of this narrative. By enabling CXL, that's Compute Express Link, the open standard protocol that allows CPUs and GPUs to share memory pools, Astera allows for more efficient resource utilization. This means less power wasted on redundant data movement and more effective use of expensive HBM, high bandwidth memory, the specialized, high-speed memory chips that sit next to the GPU. Astera is the company that makes AI cleaner and more efficient at the physical layer. As the political pressure to curb AI's energy consumption grows, the companies that provide the most efficient interconnects will be the only ones left standing. The macro environment is not a storm that will sink Astera. It is a filter that is burning away the noise, leaving only the essential, high-performance infrastructure providers to capture the remaining capital. The market is currently mispricing the durability of this moat, and the upcoming quarters will prove that Astera Labs is the most stable pillar in an otherwise volatile AI infrastructure landscape. ALAB reported earnings per share of $0.61, beating the Wall Street estimate of $0.55 by 11.6%, a solid beat that signals strong execution. ALAB is trending higher, currently at $348.10. The official narrative surrounding Astera Labs is a masterclass in growth stage optics. If you read the headlines today, you're told this is a high-conviction, high-insider ownership play, bolstered by an 11.6% EPS beat and a four-quarter streak of performance surprises. Management wants you to focus on the AI demand and the unprecedented growth of their interconnect portfolio. They are painting a picture of an inevitable winner, a company so essential to the AI rack that its success is locked in by the laws of physics. But when I look at the actual filings, the corporate gloss begins to peel away, revealing a much more complicated reality. Let's talk about the insiders. In the last 90 days, those same executives who talk so confidently about long-term strategic positioning have net sold 2,306,257 shares. That is not a minor rotation. That is a significant liquidity event. When management speaks about shareholder value, while simultaneously offloading millions of shares into a market currently paying a premium for their growth narrative, you have to ask what they know that the retail buyer doesn't. Historically, this pattern of aggressive insider selling during a period of peak valuation suggests that the internal team believes the current stock price has fully priced in the next 2 years of perfection. They are effectively signaling that the easy money phase of the AI infrastructure trade is in the rearview mirror. Management's language is equally revealing. They love to talk about supply chain optionality, a beautiful, vague term designed to make investors feel comfortable about their dependence on TSMC and other foundry partners. In the PR world, optionality is code for "we are terrified of a bottleneck we cannot control." They are essentially admitting that they have no leverage if their manufacturing partners decide to prioritize a bigger fish like NVIDIA or Broadcom. When an executive pivots from talking about market share to supply chain optionality, they are no longer selling growth. They are managing the downside risk of being a small player in a massive, capital-intensive ecosystem. What management is saying is that they are masters of their own destiny. What the lab hears is that they are one supply chain hiccup away from a margin collapse. The PR team is papering over the fact that Astera is a captive of its own suppliers, and that is a reality that no amount of positive earnings beat language can change. Look deeper at the numbers. While the EPS beat of 11.6% is the headline, the real story is the R&D burn. Astera is dumping $304 million into R&D, which is 35.7% of their total revenue. That represents a 51.4% year-over-year increase. On the surface, this looks like investing for the future. In reality, this is a defensive moat-building exercise. They are spending at this breakneck pace because they know their current PCIe retimer technology is a commodity that will eventually be disrupted by co-packaged optics or deeper integration by the hyperscalers themselves. They are running on a treadmill, spending half their revenue just to ensure they aren't rendered obsolete by next year's silicon revision. If that R&D spending as a percentage of revenue begins to trend downward, it won't be a sign of efficiency. It will be a sign that they've stopped trying to innovate and are simply milking a dying product line. Institutional investors currently hold 82.8% of the float, with top-tier funds aggressively increasing their positions. This creates a dangerous feedback loop. These funds aren't buying because of the long-term fundamentals. They are buying because the stock is part of the AI infrastructure index, and their mandates force them to own it. But look at the 10Q risk factors. With 25 distinct risk disclosures, the company is legally covering its back against exactly what I'm describing: customer concentration, intense competition from the likes of Broadcom, and the rapid, unforgiving nature of technology transitions. The auditors are screaming what the CEO is whispering. This is a business with zero margin for error. Here is the inflection point you need to watch. In the next 10Q, look specifically at the customer concentration line item. If revenue from their top 3 hyperscalers shifts by even 5 percentage points, the stock will get hammered. If you see the R&D expense growth rate drop below the revenue growth rate, run. It means they've hit the wall and are prioritizing short-term margins over long-term survival. The bull thesis for ALAB is built on the idea that they are the essential glue of the AI rack. The bear thesis is that they are a temporary bridge to an integrated, optical future that will eventually bypass them entirely. Management is selling you the bridge. I'm telling you to watch the water levels below it. The lab's verdict. ALAB is a high beta trade, not an investment, and the current insider selling is the loudest signal in the room. The momentum breakdown for ALAB. RSI sits at 80, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. The bull case for Astera Labs rests on 2 pillars of physical reality that Wall Street is only beginning to grasp. First, the PCIe 6.0, the 6th generation of the Peripheral Component Interconnect Express standard that doubles bandwidth to 64 gigatransfers per second. Upgrade cycle is an absolute necessity for hyperscalers. As GPU racks hit 100 kilowatts of power density, signal attenuation becomes the primary enemy, and Astera's Leo retimers are the only reliable way to prevent packet loss at these speeds. Second, their Aries CXL, the Compute Express Link protocol that enables memory pooling. Controllers are solving the most expensive bottleneck in modern data centers: stranded memory. By enabling CPUs and GPUs to share a common memory pool, Astera is essentially increasing the effective compute density of every rack they touch, making them indispensable to the hyperscaler bottom line. But here is what breaks the bull thesis. The valuation at a forward P/E of 82.7x leaves zero margin for error in an environment where customer concentration is a structural vulnerability. If a single hyperscaler pivots their capital expenditure toward custom silicon that integrates retimer functionality on die, Astera's revenue evaporates overnight. Furthermore, Broadcom, the semiconductor giant that dominates the networking space, has the manufacturing scale and existing vendor relationships to aggressively price their own connectivity chips, potentially squeezing Astera's margins before they can fully capture the PCIe 6.0 upgrade cycle. With the stock trading at 98% of its annual high, the market is pricing in perfection, and any sign of a slowdown in server platform deployments will trigger a rapid repricing toward the 200-day moving average of $180.88. Here is the question that makes the room go quiet during an earnings call. Given the move toward co-packaged optics, how does Astera maintain its moat when the copper-to-optical transition eventually renders your current retimer portfolio obsolete? The lab's answer is simple. The transition to optical interconnects is a timeline game, not a binary event. While co-packaged optics, where lasers are integrated directly into the chip package, will eventually replace copper, the thermal and manufacturing yield hurdles for 1.6T speeds are massive. Astera is already pivoting their R&D toward optical IP to bridge this gap. However, the real test isn't the technology. It's whether they can secure the same design win dominance in the optical space that they currently hold in the copper-based PCIe market before the current cycle peaks. If Astera Labs maintains its design win momentum as the next generation of server platforms launches in late 2026, the stock will likely test the resistance level of $349.17 and establish a new base above $380, driven by the sheer scale of the AI infrastructure supercycle. Conversely, if the company shows any deceleration in customer adoption or if export control compliance forces a pivot that compresses margins below 60%, expect a violent retest of the $195.65 support level as the high forward P/E multiple contracts. Our AI score of 66 out of 100 reflects a high-conviction growth story that is currently priced for perfection, meaning the path of least resistance is consolidation until the next earnings report confirms that the PCIe 6.0 revenue inflection is actually hitting the balance sheet. Watch the volume. If it continues to track 20% below the 20-day average while the price remains near $348.10, the lack of conviction suggests a consolidation phase is imminent. ALAB's latest contract win boosts its margin outlook dramatically for the quarter. After this deep dive, are you a buyer of ALAB right now or still on the fence? Tell us why.